A $4 trillion asset just crashed 40% in 2 weeks. Silver, one of the oldest, most stable commodities in human history, traded like a meme coin. And if you were holding it, you got absolutely destroyed. But here's what they're not telling you. This wasn't a natural market correction. This wasn't retail panic or algorithmic trading gone wrong. This was a controlled demolition, a coordinated takedown engineered by some of the most powerful banks in the world to save themselves from catastrophic losses. JPMorgan was staring down $5 billion in unrealized losses on their short positions. They were caught offside at $120 per ounce. And if silver kept climbing, they were facing potential insolvency. So what did they do? They triggered a paper market crash. They manipulated the futures exchanges. They exploited system outages and market glitches. And they walked away with $765 million in arbitrage profits, while retail investors got slaughtered. This isn't speculation. This isn't conspiracy. This is documented behavior from banks with a proven track record of rigging the silver market. JPMorgan was literally fined for manipulating silver prices between 2009 and 2016. They got caught placing fake sell orders to crash the price and pocket the difference. And they just did it again. In this video, I'm going to walk you through exactly how they pulled it off, the timeline, the tactics, the smoking guns, and why this matters far beyond silver, because the same playbook is being used in Bitcoin, gold, and every other market where big money has exposure. Let's break it down. To understand how this crash happened, we need to start with the catalyst that set everything in motion: China's silver export ban. On January 1st, 2026, China officially classified silver as a strategic mineral and imposed strict export controls. Overnight, private sellers were banned from exporting refined silver. The only entities allowed to export were a handful of state-approved firms, reportedly just 44 companies in total. This was a massive supply shock. China controls 60 to 70% of global refined silver production. When they shut off the export tap, they effectively strangled Western markets of their primary supply source. And the market reacted accordingly. Silver prices started climbing, physical premiums spiked, delivery time stretched out, and suddenly the bulls had the upper hand. But here's the problem. The big banks, especially JPMorgan, were heavily short silver. They'd been betting on lower prices for months, maybe years. And when China's export ban hit, their short positions started hemorrhaging money. At first, the market assumed this would be a temporary disruption. Maybe China would reverse course, maybe alternative supply chains would open up. But as January progressed, it became clear China wasn't backing down. The export ban was real, structural, and long-term. And that's when the panic started setting in. Not for retail investors, but for the banks. The next domino to fall was in Hong Kong. In early to mid-January, rumors started circulating that several Hong Kong-based trading firms had blown up. These weren't small players. They were well-capitalized funds with exposure to silver, Bitcoin, and other volatile assets. The exact details are still murky. But the speculation is that these firms were heavily leveraged long on silver. When volatility spiked and margin requirements increased, they couldn't meet their obligations. They were forced to liquidate. And when large leveraged positions get forcibly unwound, it creates a cascade. Sell orders flood the market, prices drop, other leveraged players hit their stop losses, more selling follows, and the whole thing spirals. This forced selling added significant downward pressure on silver. But it also had spillover effects into Bitcoin and other risk assets. Some analysts believe the Bitcoin sell-off we saw in late January was partially linked to these Hong Kong liquidations. But here's where it gets interesting. The timing of these blowups was suspiciously convenient for the banks. Just as silver was rallying to levels that threatened their short positions, suddenly a wave of forced selling appears out of Hong Kong, driving the price back down. Coincidence? Maybe. But when you look at the full timeline of events, it starts to look a lot more like coordination. Now, let's talk about the rally itself, because this is where things get statistically absurd. Silver's rise in late 2025 and early 2026 was classified as a 6 sigma event. In statistical terms, a 6 sigma event has a probability of roughly 2 in 1 billion. That's not rare. That's practically impossible under normal market conditions. For context, a 6 sigma move means the price action was so extreme, so far outside the expected range of normal volatility, that it shouldn't happen in the natural course of markets. When you see a 6 sigma event, it's almost always driven by forced market conditions. Things like supply shocks, margin calls, exchange failures, or manipulation. In this case, silver had rallied 132% over the course of 2025 before the crash. That kind of move doesn't happen organically in a mature, liquid commodity market. It happens when there's a structural imbalance, when physical supply can't keep up with demand, when shorts are getting squeezed, or when large players are accumulating positions. And here's the kicker. The rally was good for almost everyone except the banks. Retail silver stackers were making money. Miners were profitable. Industrial users were hedging supply risk. But for JPMorgan and other heavily short institutions, this rally was an existential threat. At $120 per ounce, JPMorgan was sitting on $5 billion in unrealized losses. If silver kept climbing to $150 or $200, those losses could have exceeded their risk tolerance. They could have faced margin calls, forced buybacks, or worse, insolvency. So they had two choices. Let the rally continue and risk catastrophic losses, or kill the rally and survive. They chose survival. Let's zoom in on JPMorgan's position because this is the smoking gun. At the peak of the rally, silver hit $120 per ounce. And JPMorgan, one of the largest players in the silver futures market, was massively short. Their unrealized losses at that price level were estimated at $5 billion. $5 billion? That's not a rounding error. That's not a minor portfolio bleed. That's a bank-threatening loss. Now, JPMorgan is a massive institution. They have trillions in assets. $5 billion won't bankrupt them. But it's enough to trigger serious internal alarms, risk committee meetings, and emergency action. And here's the thing. If silver had continued higher, say to $150 or $180, those losses could have doubled or tripled. And at some point, the losses become so large that they start affecting the bank's overall stability, their credit ratings, their regulatory capital requirements. So JPMorgan had a vested interest in stopping the rally, and they had the tools to do it. How? By flooding the paper market with short contracts. The vast majority of silver trading happens on futures exchanges like Comex and the London Metals Exchange. These are paper markets, contracts that represent promises to deliver silver, but where physical delivery almost never happens. And here's the dirty secret. If you're a big bank with deep pockets, you can create unlimited paper supply. You can sell short contracts, even if you don't have the physical metal to back them. You can overwhelm the market with sell orders, drive the price down, and then cover your shorts at a profit. It's called spoofing. It's illegal, and JPMorgan has been caught doing it before. So how did they pull it off this time? Starting around late January, the paper market was flooded with massive sell orders. These weren't organic trades from retail investors or industrial hedgers. These were large, coordinated orders designed to create the appearance of overwhelming selling pressure. The goal was simple: break the psychological support levels, trigger stop losses, force liquidations, and drive the price down fast enough to shake out the bulls. And it worked. Within 2 weeks, silver crashed 40%, from $120 at the peak down to around $72 at the bottom. A $4 trillion asset moving like a penny stock. But here's the key. The crash was almost entirely driven by paper selling. Physical silver remained tight. Premium stayed elevated. Delivery times were still stretched. The physical market was sending one signal, and the paper market was sending the opposite. That divergence is the hallmark of manipulation. When the paper price crashes, but the physical market stays strong, it means the selling isn't real. It's synthetic. It's engineered. And JPMorgan had every incentive to engineer it. Now, if you're skeptical that JPMorgan would actually manipulate the silver market, let me remind you, they've done it before, and they got caught. Between 2009 and 2016, JPMorgan was systematically rigging the silver and gold markets. Here's how it worked. They would place large sell orders on the futures exchanges, orders big enough to move the market. But these weren't real orders. They had no intention of letting them execute. They were spoofing orders, designed purely to create the illusion of selling pressure and drive the price down. Once the price dropped, they'd cancel the fake orders and buy at the lower price. Then they'd repeat the process, over and over, for years. In 2020, the Department of Justice charged JPMorgan traders with racketeering, yes, racketeering, for running this scheme. The bank was fined nearly $1 billion. Multiple traders were prosecuted and convicted. But here's the thing. The fine was a slap on the wrist. The profits they made from the manipulation far exceeded the penalty, and none of the senior executives faced criminal charges. So what's to stop them from doing it again? Nothing. And that's exactly what we're seeing now. The same playbook, the same tactics, the same outcome. Large sell orders appear out of nowhere. Prices crash, stop losses trigger, and by the time retail figures out what happened, the banks have already closed their shorts and locked in their profits. So here's where the story gets really interesting. According to market rumors and trading data analysis, JPMorgan allegedly closed the bulk of their short positions around $78 per ounce. Remember, they were underwater at $120. But by engineering a crash down to $78, they turned a $5 billion loss into a break-even, or possibly even a profit. How? Because when you're short, you profit when the price goes down. If they shorted at $90 and closed at $78, they made $12 per ounce on the trade. But it gets better. Once they closed their shorts, they allegedly flipped long. They started buying silver, not at the top, but at the bottom during the panic. And here's the genius of the play. They didn't just buy physical silver, they bought silver ETFs at a massive discount. During the chaos of the crash, something bizarre happened in the ETF market. Silver ETFs, exchange-traded funds that hold physical silver on behalf of shareholders, started trading at a 19 to 20% discount to the actual spot price of physical silver. Think about that. The ETF, which is supposed to track the price of silver almost exactly, was trading 19% lower than the metal itself. That's not a normal arbitrage gap. That's a dislocation. It means the market was broken. And guess who was ready to take advantage? The banks. When an ETF trades at a 20% discount, it's basically free money for anyone with the capital to buy in size. You buy the ETF at $80 when the physical metal is worth $100. Then you wait for the gap to close. When it does, you've made a 25% return risk-free. And according to reports, JPMorgan and other banks went all in on this trade. They bought massive positions in silver ETFs during the dislocation, rode the rebound, and walked away with a 100% rally on those positions. So let's recap. JPMorgan was short at $120. They crashed the market to $78. They closed their shorts. They bought ETFs at a 20% discount. And as they profited again on the rebound, that's not trading, that's robbery. But the manipulation didn't stop with JPMorgan. Other banks were involved too. And the evidence is in the infrastructure failures that happened at exactly the right time. On January 30th, 2026, the day of the worst volatility in the crash, HSBC experienced a system-wide shutdown in Hong Kong. 6.2 million HSBC customers in Hong Kong were locked out of their accounts. They couldn't trade, they couldn't sell, they couldn't access their funds. And this wasn't just a minor glitch. This was a complete outage during one of the most volatile trading days in silver's history. Now, HSBC claims it was a technical issue, an unfortunate coincidence, but the timing is suspicious beyond belief. Think about it. If you're a retail investor in Hong Kong holding silver or silver-linked assets and you see the price crashing, what do you want to do? You want to sell. You want to cut your losses. But if your bank's systems are offline, you can't. You're stuck. You're forced to ride the crash all the way down. Meanwhile, the institutional players, the ones with direct market access, the ones with trading desks and prime brokers, they can still trade. They can sell. They can profit. So who benefits from a system outage during a crash? Not retail. The banks. And HSBC wasn't the only infrastructure failure that day. On the exact same day, January 30th, the London Metal Exchange experienced a pre-market glitch. The LME is one of the primary exchanges where silver and other metals are traded. And during the pre-market session, when prices are being set before the official open, the system malfunctioned. Orders didn't execute properly. Prices didn't update. And by the time the system came back online, the market had already moved significantly lower. Again, the official story is technical failure, but the timing is impossibly convenient. When critical infrastructure fails during the exact moment of maximum volatility, it's worth asking, who benefits? And the answer is always the same, the people with the most to lose if the market moves against them. So how much did the banks make from all of this? On January 30th alone, the day of the HSBC shutdown, the LME glitch, and the peak selling pressure, banks collectively made $765 million in arbitrage profits. $765 million in one day. How? By exploiting the dislocations between physical silver, paper silver, and ETF silver, by buying at the bottom during the panic, by closing shorts at favorable prices, by taking advantage of retail investors who were locked out of their accounts. This wasn't a normal trading day. This was a coordinated extraction event. And it wasn't just JPMorgan. Multiple banks participated. They all knew the playbook. They all executed in sync. And retail investors, the ones who believed in silver's fundamentals, who bought into the supply deficit story, who thought the rally was real, they got crushed. So here's the big question. Was the silver rally intentionally killed to save the banks? The evidence strongly suggests yes. Let's review the facts. Silver rallied 132% in 2025. The rally was classified as a 6 sigma event, statistically impossible without forced conditions. JPMorgan was short and facing $5 billion in losses at $120. China's export ban created a legitimate supply shock that supported higher prices. But instead of continuing higher, the market crashed 40% in 2 weeks. The crash was driven almost entirely by paper selling, not physical. Infrastructure failures happened at the London Metal Exchange and HSBC during the crash. Banks made $765 million in one day. JPMorgan allegedly closed shorts at $78 and bought ETFs at a 20% discount. When you connect the dots, the conclusion is inescapable. The rally was killed because it threatened the banks, and the banks had the tools, the motive, and the historical track record to pull it off. This wasn't a free market correction. This was financial warfare. And who paid the price? Retail investors, the people who bought silver at $100 thinking the rally was real, the people who believed the supply deficit story, the people who trusted that markets reflect fundamentals. They got baited, they got trapped, and they got liquidated. Meanwhile, the banks walked away with profits. JPMorgan closed their shorts. They bought the bottom. They arbitraged the ETF dislocation, and they lived to fight another day. This is how the game works. Retail investors are the prey, banks are the sharks. Retail believes in narratives, banks believe in survival. Retail trades on hope, banks trade on leverage and manipulation. And when push comes to shove, the banks always win, because they control the infrastructure, they control the exchanges, and they control the rules. So where are we now? Post-crash, the silver market has stabilized at lower levels. The panic has subsided. The volatility has cooled, and the paper price has settled somewhere in the mid to high 70s. But the physical market, still tight. Premiums are still elevated. Delivery times are still stretched. China's export ban is still in place. So the fundamentals that drove the rally haven't changed. What changed was the paper price. And that's because the banks successfully manipulated the futures market to escape their losing positions. But here's the thing. This doesn't solve the underlying problem. The supply deficit is still real. The demand from solar, EVs, and AI is still growing. And at some point, the physical market will reassert itself. The question is, when? And the answer is, when the banks are positioned to profit from it. So what's the lesson here? The lesson is simple. Big money plays by different rules. JPMorgan can manipulate markets and get fined $1 billion, but they made 10 times that in profits. So the fine is just the cost of doing business. Retail investors can't place fake sell orders. They can't engineer infrastructure failures. They can't buy ETFs at a 20% discount. Retail plays the game. Banks rig the game. And until that changes, until there's real accountability, real enforcement, real consequences for manipulation, this will keep happening. In silver, in gold, in Bitcoin. In every market where big money has exposure. So if you're going to invest in these markets, you need to understand the rules. You need to know that rallies can be killed. You need to know that crashes can be engineered. And you need to know that the banks will always protect themselves first. Does that mean you shouldn't invest in silver? No. The fundamentals are still strong. The supply deficit is still real. And at some point, the physical market will overwhelm the paper manipulation. But it means you need to be strategic. It means you need to understand position sizing, risk management, and the psychology of manipulation. Because the sharks are always circling. And if you're not careful, you're the one who ends up on the menu. Drop a comment below. Tell me what you think about JPMorgan's role in this crash. Tell me if you were holding silver during the collapse. And tell me if you think this kind of manipulation is the new normal, or if accountability is coming. I'll see you in the next one.